So hello and good evening. No, good evening. It's probably a little too early for that. Hello and good afternoon. So yeah, we are about to have good evening here in Varna, Bulgaria. So today I'm talking from the JFD office here in Varna, Bulgaria, not from Germany, Germany, Berlin. And first of all, I hope that you can hear me well. So first of all, I'll just double check here in the chat box whether you can hear me fine. So here it's hello Jens. Good afternoon, good evening. Yeah, so perfect. Seems as everything is working fine here. Everyone can hear me well. And yeah, today will be a very interesting day. Well, or let's say we hope that it will be a very interesting day. It's a little unfortunate, let's say, what we have today. So the plan is to have a live trading event, or the plan was to have a live trading event. And I'm not sure whether we'll have a trade today. So the plan was, and this is what the slide already says here, how to trade the market opening of the US markets. And this is usually one of my favorite trading hours. So not just in the US market or during the US market opening, but also around the European market opening. Some of you might have heard about the second special event we have every week after the morning meeting, which is taking place every day at currently 9:30 a.m. GMT. So usually 10:30 a.m. GMT, but thanks to summertime, it's 9:30 a.m. GMT. And it's not just the morning meeting, but we also have the so-called DAX long or short. And this is usually taking place every Monday and every Thursday. So if you want, and everything's working fine here in the office, which means that I have a desk here. Oh, that was a mistake. 1 second. I have to. I just closed the slide. Where do we have it? Here and here. So. Then you can join me tomorrow in the morning. It will be at around 9:20 a.m. GMT. The DAX long or short, and we'll do something very similar here. It's much shorter than today's webinar. So today we want to have a quite clear and deep look behind the scenes. So what do I look for when I trade the US market opening, or in general when I trade the market opening? Tomorrow it will be a short version. It will be maximum 10 minutes, and I will just give the trading setup here, but it will be based on the same ideas I'm formulating here. And today we'll have a very deep look into what do we look for. So the US market opening, the time I'm looking for here, respectively, the time I'm trading is not 2:30, but currently, as already said, it's from 1:30. It's 2 hours GMT, and it's between 1:30 and 2:15 while or when I define the open range. And the trading hours I'm looking for here is between 1:30 and 8 p.m. GMT. And now the question is why. So you might know that the trading hours here in the Dow Jones future, for example, or in the S&P future, are nearly around the clock. So it's 24/5. Well, there's some. It's not 24 hours. There's some breaks in between. So between, now let's see, it's 10:15 till 10:30 in German time. So it's 8:15 till 8:30 GMT, PM GMT, when there's no trading taking place. And then I think another break here between 11 and 11 p.m., 12 a.m. German time. So must be 9 p.m., 9 p.m., 10 p.m. GMT. So this should be the time when there are breaks. But usually the future is traded all the time, and this is or takes place at the Globex, at the CME. But as you can imagine, usually the most traded volume, or the time with the most volume you see traded here is during the spot market being open too, which means that then, for example, arbitrageurs coming to the marketplace here and push up the volume, trying to profit from price discrepancies here between the future market and the spot market. And this is pushing up the volume and making moves much more significant than during the trading hours here, let's say during European trading hours or something. So this is the main trading time. So when I trade the US market opening, I trade it from 1:30 p.m. Till 8 p.m. GMT. So this is the main trading time frame. Before that, I'm usually trading European market hours, and here especially the DAX. And in case of the DAX, I'm usually trading the DAX between 6 p.m. I'm sorry, 6 a.m. GMT till around 5:30 p.m. GMT. PM GMT, yeah, probably a little earlier. So probably it's around 3, probably 4 PM GMT. It's not very often taking place that I'm trading the DAX longer than that. It happens once there are strong trends which are developing over the day, but usually these are the main trading hours I'm trading here. And so this has, as already stated, has something to do with the volume pouring into the market. And so that around the trading hours. And now, nevertheless, my personal trading approach, and before we start to find a clear definition here of the open range breakout setup scenario and how to identify the advantage and everything, let's give you a short idea of what I'm looking for and what I try to capitalize in my trading. So as you may know, I'm not just doing market research here and talking about my personal opinion of the markets and where the advantage can be found, but I'm also a money manager. So I'm managing clients' money, as you can see here, by the way. So currently I have a trade open. It's a Euro GBP. It's a short position, and the current attack here at the 84 was one target I was looking for. But currently I'm not just hoping for an attack of this region and now take my profit there, but what I want to see is an attack here on the downside at 83. Tomorrow we have the Bank of England. Let's hope that there will be some comments from Mark Carney, who tries to talk up the GBP, pushing up the value here of the GBP, making sure that he's not forced to hike, or the Bank of England is not forced to hike rates here, thanks to, or mainly due to the fact that they want to avoid a big overshoot here in inflation, and that way, but by hiking rates, risking that they are that this restrictive monetary policy has negative impacts on the UK economy. So that's just to give you an overview here on this current position in Euro GBP, which I'm holding. So it's not just that I'm trading the intraday time frame, but I'm also trading bigger time frames here. In this case, trading the daily chart in the Euro GBP. I could now show you more details on that, give you a fundamental idea of that, but I think the morning meeting is a way better place to discuss such topics here. I've presented this potential head shoulder formation there already. That was the technical fact. The fundamental aspects were discussed there too. Then we have the sentiment component, and based on that, I build a position here from a discretionary standpoint. But usually, when I'm trading the intraday time frame, the fundamental side and also the sentiment probably doesn't take such a big role there. But usually, in my trading, I'm especially in my intraday trading, I'm looking for significant regions in the chart. So meaning, for example, if I plan to formulate a trading setup here based on the 5-minute time frame, as you can see it here already, by the way, then usually it's that my direct dominator is the hourly chart. So what I do is first of all, I have a look at the hourly chart, and then I look for significant regions in this time frame here. And then what I try to do is I want to see a break above or below such a resist respective support, and based on this break, I hope for I hope for a trend, an intraday trend developing here. And sometimes those trends are so strong that I then migrate the trade into the next time frame. So what I'm usually doing is the following. I try to anticipate breaks of significant regions in the chart. And based on those breaks, I then try to capitalize on development of a trend structure here on an intraday basis, which I sometimes migrate to a higher time frame. So if you want, I'm kind of a trend follower, but also looking for momentum trades. So it's kind of combination of that. So this is what I'm looking for when I'm trading the intraday time frame. And now the question is, how can I find spots here to position myself to anticipate such breaks of significant regions in the dominating time frame? And here the so-called open range breakout setup comes into play, where I have a so-called discretionary component to it. And the open range breakout system or setup is very, very easy. So I first of all do the following. I identify the advantage based on the Dow theory, for example, very, very rough, by the way, or I try to identify the advantage, the current advantage here on the 5-minute simple moving average. So that's the first I do, which, by the way, we could easily do right now. Just to give you an idea what I mean when I'm talking about the rough. This is an uptrend. It's higher highs, higher lows. This is an uptrend. Uptrend means the advantage should be seen on the long side. And if I see this, it's a downtrend. It's lower lows, lower highs, and the advantage is to be seen on the short side. So now the discretionary approach. You may have heard about the so-called distribution area and the so-called accumulation area. This is where something you can easily see here. So I have a German chart here. This is a German a chart or a graph I built for or as an example here to make sure that everyone gets the point. And in German we call the so-called Ursachenbereich, the accumulation phase, or the accumulation area. This is where usually professional traders start to accumulate their position. They build their position. What they have to avoid is to build the position here in this red area, in the so-called distribution area. This is where they distribute the accumulated volume again. So why do they have to avoid this? Because this is the so-called point 2. The so-called, I'm sorry, point 3. Oh, this is, by the way, something I'm already having difficulties. I think it's a 0.3. Yeah, I think it's 0.3. So what you usually do, some might now wonder what I'm talking about here, but let me show this to you. So you start here from 1, you have 2, 3, so it's 2. Okay, 1, 2, 3, 1, 2, 3. So, and what you usually see here is that around this 0.2 in this case, if you use this notation here, that then you have the point where when the market pulled back here from those highs again, and if it makes it to higher highs from there, this is a pro-cyclical long signal, as is, by the way, here in this case 1, 2, 3, 2, 3, 2, 3, which is, by the way, here in this case, the moment when this downward sequence is, what's the word for this? I'm sorry, I'm missing the word. So it's the point where we can then see a sequence of falling highs and falling lows in this case, and you have a clear downward sequence. And so what you have to avoid is to trade long in such a breakout here. Well, or let's say avoid is probably too hard here. You have to see whether you really want to buy this, since this is, as already stated, the accumulation and the distribution area, which means the big market participants who started to accumulate volume here are starting to sell, respectively starting to buy again back their accumulated volume here. And why do they do that? Well, the higher we go here, the more unattractive the so-called risk reward gets. So what you have to avoid is to really buy here in this spot. Plus, on top of that, we as small traders, we will have definitely we will face some trouble here to see further momentum building on the upside. If all those market participants, the bigger market participants, start to sell their accumulated volume, they start to sell respectively, buy back the sold volume here once the market pushes to new highs. So, and this is one of the reasons. On top of that, there's also the fact that here are lots of stops located above those highs. So if you plan to trade such a regression here, you usually say, okay, where do I have to place the stop? At latest here above those highs. Why? Well, once the market moves to new highs, it's definitely a clear bullish sign. So you don't want to be short in a bullish market environment and the other way around. So, and that's the idea behind this. It's a very, very rough idea, but it's highly effective, since you avoid to, for example, go aggressively long. By the way, I have to close all this here. Let's say what I want to avoid in my trading is to go aggressively long once the market pushes to new highs. I just want to avoid that. And that's one of the reasons why I say, well, once the market has such a sequence here, I say, okay, it's higher highs, higher lows. Once we trade here, I'm aggressive. And once we are here, if I go long at all, I'll be more conservative with my position size. Probably I try to be very aggressive here and trade the trade a pullback from there. So be in a bullish market environment short and try to trade such a pullback here to this level. This is, by the way, something which now makes sense for all those people who've read my German piece, by the way. So probably we have also some English-speaking German readers of my research piece from the morning here, and they may have wondered why I'm planning, or why I say, well, I could imagine to go short the DAX here after the victory of Macron, and here the anticipation of such a victory in the DAX already last Friday. I said, well, somewhere between 50 to 80, I probably plan to position myself short to try to see a break here of this region, anticipate a break of the region around 650. Since the higher we move here, the more unattractive it gets to go pro-cyclical long. And so this now makes perfect sense. Why do I consider short engagements a good possibility and high risk reward trades here? And this is something where the so-called discretionary approach is. So what I do is I look for an advantage based on a very rough idea, looking for higher highs and higher lows, or lower highs and lower lows, meaning in the first case, we have an upward structure. The advantage is on the long side. And here, by the way, now the cycle closes. You might have wondered why I just said, well, I'm a professional money manager. So what my clients want me to do is identify an advantage and then capitalize on this advantage over and over and over again. You may have heard or listened to several webinars from my end here, also in English. For example, the 3 columns of profitable trading. So it will be, by the way, tomorrow at 1 second. Will be at 2:30 p.m. Yeah, 2:30 p.m. GMT. I will talk again about those 3 columns of profitable trading. The one column you might you have rightly guessed is risk and money management. And risk and money management, here we are also talking about something called the so-called expected value. The expected value tells you whether when you have a clear idea of your hit rate, your loss rate, and your average winner and your average loser, the expected value tells you, if you put all those 4 components into this formula, whether you have a positive expected value or a negative expected value. If you have a positive expected value, it means that on average, you're making money on this trading idea. It doesn't necessarily mean that you're making money every time. So just imagine you have a hit rate of 40%. That means you're hitting 4 out of 10 times. But now imagine you're making 3 times as much as you do on average as you do when you're losing. meaning you have a hit rate of 40%. You multiply it by 3, you have 1.2, and then you subtract 0.6 from it. So it's 1 multiplied by 60% or 0.6. At the end, you have 0.6 as the result. It's bigger 0. And it says that on average, per euro you risk in your trading, you're making on average 60 cents. So on average, for every euro you're taking on a risk, you're making 60 cents. Meaning, let's say risk 1,000 euros. You're making, if you repeat this setup over and over again, on average, it doesn't matter if you win or lose. You're making 600 euros per trade, with the setup happening over and over and over and over again, and taking the setup over and over again. So meaning that what we are looking for as a money manager or as a trader in general is we look for advantages which we try to capitalize. If you do not have an advantage, well, you don't need to trade. It might happen that you once in a while hit are on the right side of volatility here, and making money, well, just out of pure luck. But all in all, in the long run, you will definitely lose if you do not have a clear advantage identified. And that's the reason why I'm looking to identify an advantage. So before you set up a trade next time, make sure that you know, first of all, what you're doing, that you know the strategy you're trading, and if it has a positive expected value, and then you go for it since you know it has a positive expected value, meaning you have an advantage on your side. If you do not have an advantage, well, you definitely will lose in the long run. And this is something which is clearly defined here in 1. So identify an advantage. In this case, identifying the advantage, where is the current advantage located, based on a simple idea of higher highs, higher lows. So meaning you have an uptrend, meaning the advantage is on the long side, and the other way around. I'm definitely saying something here. It's a rough approach, since let's imagine the following. Just imagine that you're having such a sequence here. Higher highs and higher lows. It's a clear uptrend, no question about it. But now you have 1, 2, 3, 4, 5, 6, 7, 8. It's 8 progressions here. So the older a trend gets, the more likely it is that the trend rather sooner than later will turn around, and you'll see a sequence of falling highs and falling lows, and this trend will be broken. So if you catch most of the trend here in the middle, then you will definitely make money, and you won't care about the moment here once the trade turns around. But now imagine you have you haven't catched or you haven't caught much of this meat in the middle here, and now you plan to go long here, aggressively long there. Is this a good idea? I don't think so. So it's also a question of thinking logically, let's say, and saying, okay, well, the chances that the trend turns around is probably or currently probably higher than it is to be kept up here, and keep on writing such a sequence of higher highs and higher lows, or lower highs and lower lows. So that's why I say rough here. Unfortunately, we do not have the chance to really go into much details here, but because the time is just too short for this. But now you have a clear idea, or a better idea, let's say, of why it's necessary to identify the advantage. Next step is you define the open range. So the setup is very, very simple. And usually I'm working in the MetaTrader 4 with an indicator called this the open range indicator. So right now nothing happened, but what you will see here is that here the market will start to, in this case, by the way, why is this happening here? Something's not working here somehow. So what you will see then is that the market, or let's go here, that it automates here the high and the low in the range between 130 till 215 GMT here, making sure that I have a clear high and a clear low. And then it's very easy from there. So it's a so-called breakout indicator. So if you're interested, just shoot me a mail. I can send it over to you. No problem. It's an indicator. You can also Google it if you want. And if you have this indicator, well, then it's getting really easy. You have the open range defined, you have the advantage, and then you do, in step 3, you trade, you do the following: you trade the break of the open range in direction of the identified advantage. So if the advantage is is on the long side, if you define the advantage to be on the long side, well, you trade the open range breakout in direction of this advantage on the long side. Or the other way around. And very easy, you do the following: you trade the break on the upside and you put the stop below the lows of the range, or if the advantage is on the short side, you trade the break on the downside and put the stop above the highs. That's it. So this is the setup. So now what you do is the following: if you have this clearly defined setup here, you do the following. You start to think about, okay, how can I profit the long term, or how can I optimize my payoff here? Meaning, if I have the open range defined and I find myself here in this so-called accumulation area, accumulation phase, I should expect here big market participants to push into the market and then start to aggressively buy or aggressively sell the moment we see a downtrend here. And then I try to trade this break as aggressively as possible on the upside to make sure that my average winner is significantly bigger than my average loser when I lose. Making sure that the payoff ratio, the so-called payoff ratio, which is the average winner compared to the average loser, is positive, where is getting bigger, since, as already stated, the formula for the expected value contains this payoff ratio already. So here, the expected value, I've already made this a topic, so unfortunate that I didn't write it down here before. So it's the hit rate, you multiply it with the average winner, and then you subtract the loss rate and multiply it with the average loser. So, as you can see here, obviously you have the payout ratio somehow included in this formula. Average winner divided by average loser. So, and that's it. Okay, so what you plan to do is you somehow try to optimize the expected value by making the average winner big, and here meaning that you're pushing up the payoff ratio. And this means you plan to trade as aggressively as possible here in this region from the long side, while you start to reduce or probably trade an anti-cyclical setup here once you find yourself in the so-called distribution area, to make sure that here, even though you have the advantage on the long side, you may say, well, I somehow consider it to be more likely that the market will come down from here. Respectively, I consider it to be better to, even if I trade in direction of the identified advantage here, I plan to then reduce the position size to make sure that if I lose the trade, oh, I'm sorry, that's not right. This is, by the way, now getting. Let's come back to the setup here. So we have those 3 steps we're running through, and now what we're doing is we come back to that point here with the green and the red box, the accumulation area and the distribution area. Once we're trading in the accumulation area and the green box in our dominating time frame, we're going aggressively in direction of the identified advantage once we're trading here in this green box, while the moment we are trading here, once the trend is already somehow a little heated up, let's call it, we then say, okay, we are more conservative with our approach, or, and this is the more aggressive touch here, we go anti-cyclical short, because we think that usually rather sooner than later here, the big boys, let's call them, will start to sell their accumulated volume here, and then there will be a higher supply than demand, which will make the market coming down. Doesn't necessarily meaning that the market will break the upward structure, but at least will correct some of this last progression here. And in this case then, and now this formula comes into play, we try to reduce the loss rate in case of the second approach here, going short, while here we try to with this approach being more conservative with our position size, making sure that the average loser is reduced, while if we go along here in this so-called accumulation area, we try to make the average winner big, respectively, somehow influencing the hit rate, since we expect those big boys from the dominating time frame coming into the market and pushing the market in our direction. So this is by the way the whole idea behind this approach here. And now what we do is, well, we look at the Dow Jones right now, and what we do is we define the current market environment. And here the big problem comes into play, something I already told you at the beginning of this webinar. So right now, volatility is really, 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 really low. Really low. And the volatility can be found here in the so-called VIX. This is the volatility index in the S&P, or on the S&P. Right now, we are pushing back above 10. This is a big deal, since the last days we traded below 10, which couldn't be seen here for a very, very long time, or to tell you exactly how long it hasn't been that we've traded here in those volatility in those areas here in terms of volatility. Last time it was around Christmas 1993. I somehow tried to find out what I did back then. So back then I was 9 years old, and it must have been something great my parents did for me and my brother here back around Christmas. But it was a time when I wasn't interested in trading the markets, that's for sure. So it's been a while since we've seen such low volatility, such a low volatility market environment here. And this is for quite a long time if you look at the fact that we have the time frame between 1990 and 2017, so 27 years. And so right now, volatility, as already stated, is really, really low, making it highly difficult for me to find good spots to trade the market. And why is that? Well, as already said, what I want is, I want to see a market moving in a direction here, having a clear trend, and somehow breathing in a way where we can say, okay, the market breathing here means there is enough volatility in the market, making it likely that there will be kind of big moves even on an intraday basis here. And this is definitely right now not the case. So the day before, on the 8th of May, 2 days ago, the same guy here, Charlie Bellello. By the way, if you want to have great stats, I'll highly recommend following this guy on Twitter. He also had another stat here. So the S&P, covering the S&P, well, but it doesn't necessarily mean anything if we look at the S&P or the Dow Jones. Both are highly positively correlated to each other, both equity markets. So the S&P 500 has seen between 1917 and 2017, so we talk about 47 years, we have seen the third lowest 10-day range, high to low as a percent here, in this time frame. So the last time we've seen a 10-day range below 1%, that was where, let's say, in a region around 0.9% and below that, that was in 1994. That was, by the way, 1 month after this low VIX number were covered here. And the time before, that was in July 2016. So the market right now is really drying out, thinning out massively, and making it highly unattractive to even covering it for a pure setup here, from a pure setup perspective. So each day in Germany, I usually have a so-called JFD live trading TV. What the plan behind this, I think, is a great plan. What we do is we formulate a trading setup here based on my approach trading the S&P, but also the German or the European equity markets. And so the idea behind this is really great. But after or during the last weeks or months, by the way, so it's been horrible. So usually it makes really fun to cover these events, but more and more I start to cover other markets, since it doesn't necessarily doesn't make sense to cover such an volatile market environment here around the Dow Jones, and unfortunately it hasn't changed so far. So meaning it will be very difficult also today to formulate a trading setup. We have some time, probably something weird will happen during the next 30 minutes. So you may remember, so right now we have what is it? It's yeah, it's 1:45 GMT. So meaning that 1:45, we still have time up to 2:15 p.m. GMT here to see bigger moves here, and then probably formulating some kind of setup here. But as already said, it's highly unlikely. What we need is some kind of external event hitting the markets wherever it may come from, and then hoping that volatility starts to pick up here, and making it right now really, really difficult to formulate a setup. But what we will do is, nevertheless, we'll have a look here from the ideas I formulated, since the idea itself is still in play, is working for years, decades right now. So this approach with the open range breakout goes back as far as the early 80s, and it was it was discovered by a guy called Toby Crable. And if you want to look up his ideas, you have to bring some money, since the books are nearly sold out. So there are no copies available anymore. And now let's do the following. So if I look for Toby Crable, day trading, short-term price patterns, and opening range breakout. That's it from the beginning of the 19th, so August 1990. And there's one copy. And as you can see here, it's from 1,000 euros up. So you have definitely to pay a lot of money for those 288 pages. So the idea behind all this is not new, but currently very difficult to trade with in such an volatile market environment. Nevertheless, it makes it very attractive to then position yourself in a time frame, in a low time frame, let's say on a 5-minute time frame. And if you catch a big move, you can then start to migrate the trade and try to capitalize on it in a bigger time frame. So it's not necessarily sad that you say, okay, I take out the position here. By the way, we'll talk about how to take out the position and what are potential take profit levels here, how you could manage a trade and everything a little later on. But what you can also do is you can then say, okay, I take the position into the next trading day, since I expect the market now to develop a very strong trend based on the initial impulse here. So, and the great thing about this is that with this approach, you have a good chance to make exactly what all good trading books recommend: make your winners big, let your winners run, and cut your losers short. Since the payoff for such trades is sometimes phenomenal. So just to give you an idea, last year I was in a trade here based on this approach. The payoff was, I'm not sure, it was 20 or 25 to 1. It was crazy. So the initial risk I took on this trade was 0.8%, and the trade turned out 16% of my overall trading capital. So it wasn't a going long here and risk everything I have or something to generate a high return, but I just risked 0.8% and was capable of letting this trade run and generating a profit of 16% of my overall trading equity, which was the greatest and biggest trade the last year here. So don't necessarily say, okay, I can't use the strategy. Probably just write it down, test it for you, but don't expect it to perform well in the current market environment. That's what I want to say here. Nevertheless, I want to give you a short idea of how you could adapt this, or could use this approach here in the market environment, even though we won't formulate a clear trading setup here, respectively trade a clear setup. So we can formulate one, but we won't trade it. So currently, obviously, the market is in a bullish environment. So this is the daily chart, as you can see. So the next move up here should be expected once we make new all-time highs. So it's a clear bullish market environment, and if you plan to anticipate a break here, then you should anticipate on the upside and not on the downside. So that's for sure. So that's the daily chart. It's the dominator of our dominator. The next thing we do is we go here to this chart, and we'll look the Dow Jones here in the 1 hour time frame, and probably zoom in a little, and somehow you can see it's just another zoom. What you can see is that obviously the market is consolidating right now here between 21,070 points on the upside, and probably here 20,880 points. So that's a consolidation, but it's still a bullish consolidation. So what we can see is the market pushed higher from here and is currently trading in a consolidation area where we now, probably try to anticipate breaks here on the upside, which will then push us to new all-time highs. And by the way, very interesting to note here is the market is right now trading at the down, at the lower end of this range here. So probably favoring long engagements here against this setup, against this range, and against this level around 20,900 points. And now we look at the open range, and we wait for the open range to develop itself here. Right now, it's still too early, so we still have 25 minutes to wait for this, so you need to be patient. But what we can do then is we can try to trade a break here, probably in direction of this trend, even though you might say, well, look at what happened yesterday. I mean, we came off from those highs, and currently the market is obviously topping out a little here, and probably going for at least another attack of this region here, of this lower range, and probably trying to push below that, probably pushing, I don't know, towards 20,700 points or something. That's definitely true. But if you take the overall advantage here, the market still favors the long side. So I'd consider the long side to be unattractive once we push and close below 20,800 points. But as long as we trade above this level here, I think it's still okay to try to see an attack and a push, not just towards, but also a break here above the current all-time high at 21,170 points. So, and what we'll do now is then wait for the open range to develop, and once the open range is built and stands here after another 25 minutes of trading, then we'll formulate the setup. So that's it. Now the question is, so what are you looking for? And here exactly the next thing comes into play. Some might now say, well, does it really make sense to go long here in this environment and then anticipate such a break if volatility is so low? Isn't it probably a better idea to work with a clear take profit and wait for the break to happen, since obviously the market doesn't have the momentum it needs to push through such a significant barrier here, which is the all-time high at 21,170 points. And I think this is definitely a good point, and definitely something we have to consider, especially in terms of how to get out of the market. So what we did the whole time here is we talked about how to get in the market, and this is usually something many amateurs focus on. They just ask a question: how can I get into the market? It's very easy. Just push the buy button or push the sell button, and you're in. Okay, so that's it. So what we did is we formulated a strategy. We formulated a clear setup, and it's duplicable. So meaning that you can easily, after this webinar, and if you've written those 3 points here, you can easily duplicate this. It's no problem. You can easily duplicate this open range breakout setup. If if you do not want to go here with the Dow theory, well, you could work with some oscillators, some trend indicators, moving averages, do whatever you want to identify the overall advantage here, to decide whether going long or short. Doesn't matter. It's just on you how you decide to come into the market. The thing is, what we did, we formulated a clear setup which makes sure that you can always enter the trade and not just going long or short and not knowing what you're doing. Nevertheless, from my personal opinion here, whether you're long or short doesn't matter. So what matters is what you make out of your position, if you're long or if you're short. So just have a look here at my current position. It has nothing to do with the open range breakout. It has nothing to do with the Dow Jones or something. But my current position is Euro GBP. It's a short position. So, and now look at the date when I entered this position. That was on the 16th of March, 2017. I had an initial risk of little less than 1% on this trade. And I said, well, I have a clear idea of what I want to see. I have a clear idea of the fundamentals, why they speak for the British pound. I have a clear idea of the technical side. I have a clear idea of the sentiment. And well, now I'm going for this trade. And I have to have a clear plan of how to manage this trade, respectively, how to get out of the trade. But this is something I have to decide before I enter the trade, and not something I have to do while I'm already in the market. So sometimes, probably this is not a fair way to put it, because clear rules are fine, but sometimes you have to adapt. But let's say 90% of the time, especially beginners, should focus on not just doing what the rules tell you to do in 90%, but do it 100% of the time. So just work with your setup and don't start to somehow adapt here. I mean, there was Ed Seykota who said in a book from Jack Schwager, it was Market Wizards. That's probably the best book on trading you might have ever had in your hands and get the chance to read. And Ed Seykota said, well, you have to have rules. And then, well, he named some key facts. What makes a professional, a profitable trader, and he said, well, you have to have clear rules, and you have to know when to break the rules. So Schwager initially was a little irritated, since he said, well, that doesn't make sense, right? So you have to have rules, and you have to know when to break the rules. How do you define that? Well, and I think this is the thin line which makes the good trader, which separates the good trader, the already good and profitable trader, from the great trader. This trader who's then capable of really letting winners run and cutting losers short, even though they are not stopped out. And probably they are wrong once, but in the long term, based on their gut feeling, they are right. And so and this is exactly the point. So you have to have a clear set of rules which you have to follow in your trading. And this is something which and why it's really, really important to formulate such a clear setup of rules, what you plan to do. This is, by the way, a German slide. I haven't prepared this before, but I'll take you through it, since well, you can clearly see what I'm talking about. So there's two ways of thinking about how to get out of a trade. So first is, okay, it's three ways. So first is you get stopped out. Okay, so but also here there are some things you have to consider. It's not just you get out and you trade the way, make it or break it, but well, you can easily manipulate the average loser here by scaling out of a position. Let's say you have some kind of time stop. So usually you have a trading journal telling you, okay, I don't know, the average trade length is 1 hour. Let's say it's just 1 hour as an example, and after 30 minutes you're behind in the trade. So you have an initial risk of 30 points, and you're trading somewhere between -10 to -15 points. Then you take out half the position after 30 minutes, since you have a rule saying, well, if I do this, I take out half the position once the market didn't develop the way it should have after half of the time after the average trade length. you should definitely go for this. So, and this is the way you could easily manipulate an average loser here. But you also have to find ways to cope with such current market situations. Here in this time with the market situation showing that volatility is really low, meaning in this case, it probably makes sense to not go for a break and anticipating a big trend to develop, but probably say, well, it makes more sense to work with a clear defined take profit here. So in this case, this is the first step. You could easily work with the take profit, saying you say I take 30 points risk, and I now want to see the market move 60 points in my direction, plus minus, depends, but you definitely should work with a risk reward here of 1 to 2. The second is, if you have a good feeling about the trade, the market conditions are right, the market is moving strongly in one direction, focusing on a clear and hard resist or support level here, and you're already well positioned, well, then you could say, okay, I don't work with the take profit, but there's a good chance that the market will not just attack this level, but also break this level. If not in the first move, the first attack, but still somehow in the next few minutes to hours, if there's some kind of impulse here pushing the market higher or lower. This is, by the way, something you could easily adapt to the current situation in Euro GBP. So currently you might say, well, the market is not really strong trending here. It somehow trends, you can see this, but if you're looking carefully here of what's going on, so what I did was I positioned myself into this trend, but the market started to trend here some time later. Okay, and so now we're already trading quite a while now in the region around 84 here, and now the question is, how could we adapt this idea here of what I just said to the current situation in Euro GBP? Well, just do the following. Once the Bank of England tomorrow comes together and Mark Carney or the Bank of England, they publish their statement here from their meeting, well, look at what happens. If there is some kind of hint towards a more restrictive Bank of England, that the market starts to take on momentum here, pushing strongly, really strongly into the region around 83, well, would you then work with a take profit in this region? I definitely wouldn't, definitely. Since I then say, well, there's now the sentiment playing in my direction. The market's still quite heavily short GBP, and now the fundamental driver here as well coming into play, plus the technical thing, we have a very strong support around 83, meaning if all those three come together, we have a fundamental driver thanks to the Bank of England, that market participants start to cover their short position, not just based on a Brexit negotiations, but also based on the fact that we have a Bank of England which is probably planning to be more restrictive with their monetary policy approach. We have a good chance to not just see an attack of the level around 83 here, but also a break. And now make sure that you understand this is a very, very significant level. It's the lows from December. It's the lows here from September. The moment it's the lows here from this extension here in April, the moment the market breaks below this level. And by the way, just look what happened the last times. I mean, 83, if this is not a significant level. Okay, so I'm coming back to the Dow Jones a little later on. At least what I want to do is I want to give you an idea of how you could play with the market. This is what I'm looking for. So I'm not trying, or I don't want to give you an idea of my trade here, but I want to give you an idea of how you could analyze a market and how you could come to the conclusion that there is then a significant break ahead of us, meaning that you then adapt your way of how to manage your trade and how to take a profit. So look here, if the level around 83 is not significant, well, the market would have reacted here after pushing lower from the highs here from the mid of August. So then it pushes quite high. There's the flash crash at the beginning of October. Market pushing lower again from here, coming down from 92 in around, well, it's 2 months. Yeah, around 2 months again to 83. Market pushing higher from there. But now look, the first reaction here was strong one. It was really strong. Okay, the market pushed 900 pips in around 1 month. This is a really strong move. coming down to this level again, reacting here, not breaking it, reacting, pushing, but not as high as the first approach, meaning that here, obviously, the demand is already somehow diminishing here. So now, then we see the market somehow tending lower, or not just tending lower, but coming back somehow, playing a very choppy game here, now pushing down again. Now see the reaction. Look at what happened during this time. It's not just a reaction. We have Macron being elected to French president here, being highly likely that after the first round, he will be in the second round the winner against Le Pen, which was already a surprise since Le Pen was seen ahead several months before. So this is significant. It's a big thing, the election in France. The reaction is not even close as strong as it was here, nor as strong as it was here. So meaning the demand is coming out of the market here. And the next time the level around 83 is attacked, there's a good chance that we'll get to see a break of this level. So the more often we test the level here, in this case, the region around 83, the more likely it will be that the market will break it. And then you can play with the reaction. Don't make it overcomplicated here. Just look at what happened. So the market's pushing higher 900 pips the first time. Now it's pushing up from here to there. It's 500 pips, so probably some kind of half of it. 1 second, please. And now the pullback from here, from those lows, is something like 200 pips. So 900, 500, 200. Meaning the demand is obviously getting out of the market here, making it more likely next time when we push against this level, there's no demand anymore, meaning that the market will break down significantly. This is exactly what I'm waiting for right now, and while I'm still positioned in Euro GBP short here. You can easily duplicate this idea and this probably discretionary approach to the Dow Jones and how to manage a trade. So if you look at the market here right now, obviously there's a good chance that we get to see such a break. Now look at the Dow Jones and what's happening here. So somehow the market, let's put it here, somehow the market is really choppy for quite a while now. Okay, so there was a push higher, but the market not necessarily pushing towards the all-time high again. And the question is, if you look at how volatile the equity markets are right now, if you look at the trigger events which are there or which are not there right now, if you look at the position in the commitment of traders report, for example, if you look at all those facts, well, how likely do you see the chances that the market will see a big push even today against the region around 21,080 points? It's probably not that likely. So what you should do in this case is probably go for the first approach here, working with a take profit. If you have such a specific situation as in the Euro GBP right now, well, you could definitely try from time to time to work with the so-called super trend. In this case, for example, it's just an example, but this is usually what I do if I trade the DAX here, or if I trade the Dow Jones, and if I see a strong trend developing here. So what I do then is I take out every take profit level on the downside or on the upside. I probably have kind of the take profit which I put somewhere 500 points away or something. Why do I do that? Very simple. I bet on a flash crash to happen. I never ever profit from such a flash crash, but it happened often enough in gold, in crude oil, in the Dow Jones in May 2010. You may remember that day. Also in the S&P back then. Also in the DAX back then. You've seen the flash crash in the GBP. So this is usually what I do. So I place somewhere such a, let's call it a fishing limit or something like that. So fishing take profit somewhere. Not meaning that I see the market to go this way, but meaning that I could imagine that the market someday might see a huge squeeze to this level. Especially once we build some kind of sentiment extremes. And this is why I do that. And then taking out this take profit level here, so the near take profit level, putting it somewhere like 500 to 700 points away, and then try to profit from a trend structure developing. In this case here, this is an example from a DAX trade I made that by the way, this is a little unfortunate, but it's a perfect example to show you what I'm looking for. So usually what I do is I work with current examples to really show you that I traded that I trade the DAX this way, and to not just show you examples from, I don't know, 10 years ago, to show you, well, you could do this, but then obviously this strategy not working anymore or something. I'm not sure about this trade anymore, to be honest. What was the main reason for that? Probably it had something to do, I'm not sure, it was in September. Probably had something to do with the market gapping up here, and then not just gapping up, but developing a trend structure. And it was based on an anti-cyclical setup, so it nearly had everything in terms of what I just presented to you. But however, so I identified the advantage to be on the short side. So that's the first step. Okay, so Vorteil is advantage in German. Open range, then you can define it 10,293 to 10,340. In this case, the DAX, meaning this is the equivalent to the Dow Jones open range, which is, by the way, ready in about 5 minutes. So I find the open range here for 46 points, and I have the formula, the setup, which is I go short at 293. I have the stop 1 point above here, this the high of the open range, and then I look for a target around 10,200 points. However, I came there, and that's it. So here you can see the open range. This is those two lines. In this case, magenta, or rosa, or pink. However, the turquoise line is the in the case of the DAX, the 9 a.m. German time spot open. And here you have the 200 SMA on a 5-minute time frame to identify the advantage. So I traded on the downside since we traded below this level, but you could easily have done this also with the Dow theory approach. Yeah, and so that's the setup. So that's all I did, and you could easily adapt this to the Dow Jones or the S&P. And now what you can see here is I did the following. So hit was the first approach. It was to take profit, which I had in here in a ratio of 2 to 1, which was hit here. The dotted line is the super trend indicator. It's a trend indicator. You can follow intraday trends really well with it, and it worked perfectly several times in the past for me. There were tremendous trades sometimes, making me 250 to 300 points. Some people wondered how did I do that? Well, I didn't do anything at all. But what I did was I formulated a setup. I entered the orders. The market triggered my order, and then I just went with the super trend indicator in this case. And the great thing about this is if we have a strong trade developing and showing that the market really goes in one direction, strictly in one direction, what you usually get is you don't get buyers, respectively sellers, coming into the market, but the market just pushing in this one direction. And into the evening, when the trend starts to lose some of its momentum, it does not reverse, meaning that the more volatile the market environment gets, the closer we come to the end of the trading day, the tighter you run with the super trend behind the current market, and then you're getting stopped out. Okay, so it's a great approach, and that's why you sometimes hit the highs or near the region of the highs where you short the market, or where you go the bottom of the day of the trading day where you go along the market, and then you can run a really strong trend here, which is stopped out somewhere in the evening, and you run the whole day. You have just one trade going, making something between 250 to 300 days. I'm not saying you're doing this every day, and I'm definitely telling you, you're definitely not making it every month, but there once in a while, 2-3 times a year, you have those days. And if you really hit it hard, these are the days making a whole year performance. And the other days, you probably make some money, you probably lose some money, you're somewhere dabbling around somewhere around zero. But those 3 events are, or 2-3 trades a year, are the trades making you the whole year performance. It's in case of my trading, that's the case. So now some might say, well, but this is an approach. Is it really, I mean, if you want to make money long-term trading the markets, and if you want to live from this, meaning I do not know whether this happens, and I mean, I really can't live from this, right? I somehow have to pay my rent or whatever. So and this is something I definitely agree on. So it's an approach, and it perfectly fits not just my personality, but it also fits my way how I treat my trading, how I consider my trading, what my trading should deliver. So what I do is I use my trading as as kind of performance generator, as kind of high yield investment strategy. So I'm not using all of my money, I'm not trading all of my money, but I diversify my portfolio here, and trading is one asset of it, if you want. So my trading account is one asset in my whole portfolio I'm managing, and I try to generate a yield which is above the current market yield here. That's how I treat it, and that's why I'm not someone who needs to take out every month the money from his trading account to live from it. But what I do is I just use it as an asset, as I, for example, buy a house or something, and I'm not trading houses, but I live in this house, or I rent it to someone else. But what I want to see is a cash flow here, and this approach perfectly fits this. So what I want to say is, probably this approach doesn't fit all the people listening to me right now, respectively, I'm listening to this video, since some people might say, well, I need to have a cash flow every month. I need to make money out of this, and this is exactly the thing. What I highly recommend to you to do, make sure that you really understand what you want out of your trading. And if you do not know this, well, you have to write it down, you have to find that out, since it could be that you say, well, I trade this approach, and at the end you find out that it doesn't fit your personality, it doesn't fit your expectation well, and that is probably one of the main reasons why it won't work out the long term. So now what I want to do is, first of all, let's have a look at the questions. Probably, please share your screen. Okay, I hope that this is right now not a problem anymore. Now let's have a look at the open range and how the open range presents itself right now. So click, and as you can see here already, I mean, we are trading in a range around 20,900 points. The open range here is between 20,905 and 20,939. So this is the expected value. So this is probably, by the way, one of the main things you should take away from this. So we could trade the open range here, but probably it's more valuable if you write down this formula alone and really study it and understand what it is about, since it is the key of every trading strategy you will ever test and you will ever trade. And if you understand what expected value stands for, how expected value is defined, and which components you can influence here, which is the average winner, respectively the average loser, while you can influence whether the market goes up or the market goes down, so influencing the hit rate respective to the loss rate, well, you're already, I'd say, ahead of 90% of all traders out there, all retail traders out there. But now let's come to the open range in the Dow Jones. So you can easily replicate this to each market, especially equity markets. But you could also adapt this to the Bund future, for example, T-note future. You could try it on shares, Google. So I'm not talking about penny stocks or something, but I'm talking about shares who have high market capitalization and clear blue chips like IBM, Microsoft, Apple. You can easily try it and test it there. I've seen several traders here using this approach also on shares and doing quite well. So now let's come back here to the open range. It's 33 points. It's a little more than 0.1%. This is really tight and showing perfectly that the market conditions currently are definitely not in my favor or in favor of someone trading this setup. So as already said, let's nevertheless try to adapt this to the market currently. So we are trading at the lower bound of this range, which is building out itself here. So meaning that we want to try to trade the long side, not the short side. So what we do is we go long here. Why do we do this? Why do we do this? Let's come back to this point. Well, it's an upward structure and the consolidation here. And what we try to do is we want to see a break of at least the level here at 21,080 points. And from there, an attack on the current all-time high. So this is what we want. We want to anticipate a break here on the upside. And so this means we are trading here on the long side in a currently bullish consolidation. So we're going long against this level here, which means we're going along the open range with a break to new daily highs, 20,938. We put the stop at 20,905, meaning that our risk here is 33 points. And then you look for the target, the current target. So we said there are two ways now. First idea we could have is we could say, okay, we are working with a super trend here and trying to really anticipate such a break and then seeing a big trend developing on the upside. I want to avoid that. I already said why, since the market currently is not showing any big volatility. Or let's put it another way. Well, sometimes people ask me during the morning meetings, and they ask me, hey, how do I see whether a market is strong or whether a market is weak? It's very easy. You just look at the chart. It sounds ridiculous, but it's exactly that. You look at the chart. If you see that the market is trending the whole day already, so like, I don't know, you see the Asian markets being really weak. You see then weakness in the European markets too. And then you see that the Dow Jones, for example, is opening with a huge gap lower. Well, obviously the market is weak, so no need for big tests here or gambling around or something. Well, the market is weak. That means, well, you probably should favor short engagements here. If this fits the current market environment, market is probably being long or highly leveraged. Well, you have a good chance to get to see rather sooner than later a reduction of the long position, respectively a deleveraging taking place. And then the market is probably already showing some signs of weakness in terms of a trend structure developing, like falling highs and falling lows. If you combine all this, well, there's no real reason to play mastermind with the market and think, okay, now we'll go long again. But then just take the market on this momentum move here on the downside. That's all. And then this is the same thing for bullish market environments. This is the same for every market. If I look at the current market conditions and I see an open range here of 33 points, and I usually have, and that's, by the way, another thing we could do. Let's do the following. There are some really great indicators here, like the so-called daily range indicator. So the daily range indicator, you could download it or shoot me a mail, however you want. What you could do is you could say, okay, I want the average of the last 5 days, I want the average of the last 10 days, and I want the average of the last 20 days. So you could use 3 averages here, and you could show it for you for 1 trading week, the last 2 trading weeks, and here, well, we could also do it like 24 or something, or 25, doesn't matter. It's for the last trading month, okay? And then you just click OK. So what happens here? This, by the way, is something you have to adapt. This is usually an indicator you're using for the FX market. So it's not that the Dow Jones here had the previous day range of 143,000. I'm sorry, 14,309 points, but it says that the trading range of the day before was 143. Okay, so the trading range of the last 5 trading days was 116. The last 10 trading days was 93, and the last 25 trading days, the last trading month was 127. Meaning that all in all, you shouldn't expect the market to move 500 points now, since the current market conditions do not favor that. it can happen, but at the end, what you try to do is you try to trade a setup which you can easily duplicate and which will make money in the long term. And getting those big hits here, well, they happen, but they happen not often enough, as I already stated. I said, well, 3 times a year you're the lucky one, and you hit such a monster trade here, making the whole year performance in one day. But and this is the thing, it happens not often enough. And what's the target here is to somehow make sure that you're formulating a trading setup and duplicate a trading setup every day, which generates a permanent cash flow here. And so what should we do here? Well, right now, probably it makes the most sense to say something between 100, expect something between 100 to 120 points, the market to move in your direction, if it moves in your direction, based on the daily ranges of the days before. Meaning, well, I don't, in the current market conditions, doesn't need to consider going with the super trend here and big breaks ahead of us. No, just work with a target around the current highs, which we try to anticipate to break, but we do not see to break in the near term. Meaning we should go for something like a target around 21,080 points. That means that we have already here a reward. If this target gets hit, we have a reward of 142 points. So meaning that the risk reward, the RRR, the risk reward ratio here, is 142 to 33, and then you see it's nearly 41. 1 to 4. I'm sorry. I'm sorry. So in Germany, it's Chance-Risiko-Verhältnis. So it's the other way around. So it's reward risk, and that's why I usually write the reward first. But it's this way around. So it's 1 to how much? 4. Somehow, yeah. That's it. Okay. Is this likely to get hit here? Well, we said something between 100 to 120 points. 142 is a little more optimistic, but it's okay. Why not? I mean, it's likely based on those numbers here we have, and that's the setup. Okay, based on the open range, based on all the knowledge now about expected value, based on all the knowledge regarding what to expect here in general from the market conditions, based on the Dow theory where we are trading right now. So I think it's a good setup. We formulated here, and now you can see. So usually I do this webinar. It's way shorter. Usually it's 10 minutes. It's not 2 hours, but it's 10 minutes. And I usually formulate the setup like bam, 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 bam. Why can I do this? Why can I formulate the trading setups in 10 minutes, which now took us nearly 1.5 hours here to formulate the setup? Okay, let's take out the small interruption here with not sharing my screen while you've seen me here in the JFD office. But let's say something like over 1 hour at least. So why can I do this in 10 minutes instead of just instead of doing this every day again and again and again and working over 1 hour here? It has something to do with something very easy. I'm doing it every day for every market I look at. It's not that I write it down, but what I do is I look at those information pieces here, and then I say, okay, well, where do we trade? What do I expect based on volatility right now? Where's my potential entry? Where's my stop loss? What's my potential risk reward? And if you do this over and over and over and over again, you start to automate it. It's an automated process. And this is definitely something you should look for when you get started trading, but also when you're already an advanced trader here. I'd highly recommend doing this over and over and over again till you reach a state which is called unconscious competence. This is like driving a car, or I don't know, what's similar to that? Putting on your shoes or something, putting on your trousers. It's something you do not need to think about, but you just do it. You just go through it over and over again, and then it's like it's in your blood. You don't need to think about it. You just do it, and this is something I highly recommend here. So we could keep on talking about this and find reasons why is this, why is that, look at statistics and everything here. But at the end, it's just pure theoretically. What you should do in the future is you should look at every market from this risk reward perspective and try to figure out what's a fair setup. You don't need to trade it. What's important is you need to look at the market and boom, have to know, okay, this is the setup, potential setup, because this is the reward, this is the risk I'm taking here. So it's a positive risk reward ratio. Let's go for it. Since we are trading in the distribution area here, so we definitely should take the trade probably a little more aggressive than that. To what? Do what? Well, make sure that the average winner gets bigger, and the average loser, well, we would adopt in the moment we are trading in the distribution area here, and reduce the position size, not being too aggressive anymore, and that way influencing in a positive way the so-called expected value. And boom, you have the setup. And the more often you do this, the more likely it will get that you become profitable in your trading. So that's what trading is in the end is about. So yeah, that's nearly it from my end. The unfortunate thing is that we still have 30 minutes to go. So what I want to do is let's have a look here at the questions. Do you have any questions? If so, just let me know. I'd really appreciate to see your questions. Probably questions also not just on the setup, but questions on the current market conditions, for example. Something like that. No questions, all clear. So probably just one person joined, and it's probably right now typing a question. Oh, okay. Great questions. Where do you get your add-ons? So which add-ons you mean? Are we talking about the add-ons from JFD, or are we talking about those indicators here, for example? So for example, the story behind this daily range indicator, which I just published here. By the way, now we have to adapt the setup a little, since we are now working with a stop here below the daily lows, but not necessarily meaning that the setup is unattractive anymore. Now we are working with a stop here below 900 instead of 905. The story behind this is it's I asked a friend or a colleague of mine, and asked him whether he could shoot me over this indicator here. So that was a pure coincidence that I have this. But probably you're more talking about those add-ons, since this is just an indicator here, respectively expert advisors. But you're talking about this add-ons, right? So those add-ons, they are for free for everyone who has an account. Doesn't matter if it's demo or if it's live, has an account with JFD Brokers. So meaning if you click here on trading, I'm sorry, this is once again, so it's an English webinar. We should use the English website. So JFD has an English website, so definitely makes sense. So what you could do here is you could go via trading, and then you have here the platforms. And if you click on that, you have the so-called MT4 Plus. That's, by the way, something which is quite unique. So JFD, the MT4 is a very it's a not unique, but a platform which is used from lots of traders around the world. Many brokers offering the MT4. But what JFD did was JFD improved this by offering add-ons on this to adapt to the needs to a trader. As you may have heard, that's by the way, something which is really important to note here. So I'm not an employee with JFD Brokers, by the way. So I'm working for JFD Brokers as a partner. So I'm an exclusive partner for JFD Brokers. And when I founded my own company, that was in 2016 in July. before I started my own company, I was an employee at FXCM. You may have heard about this broker. They've gotten into the news lately around their or in the last months here, around their policy behind the scenes trading against their clients, while saying, well, we are not trading against our clients. But I wasn't working in sales for them, but I built daily FX in Germany, in Austria, and Switzerland here. And so I'll, by the way, come to those add-ons, but I have to bring up the big story here to make sure that you get the point why trader-centric is such a key word in the terms of, or in the business, in the policy of JFD brokers, in the business policy. So when I started my own company, I had a vision of being straightforward, 100% transparent, and 100% integrity. That was the fundament I planned to build my company on. And now, nevertheless, I was looking for a broker as a partner where I also offer or where capable of offering stuff like a managed account, for example. And now the thing is, you can't say with your own company, well, it's 100% transparency, 100% being straightforward, and then working with a broker who's known to trade against their clients. So you're looking for a broker which perfectly does not have a license to trade against the clients, not having a market making license. And JFD Brokers does not have such a license. So JFD Brokers is not allowed to trade the opposite of the client's trades. And on top of that, JFD, for example, offers something which is called a post-trade transparency report, meaning that you can see which counterparty executed your trade, at which date, which time, at which speed. So it's just pure 100% pure transparency, what you get at JFD Brokers. And that's the vision also from Lars Gottwig. So that was the guy you may have seen here during the last minutes who came into the room because he found out that I had some trouble here with the power. That was the CEO, and he's the founder, and his vision came true with JFD Brokers, saying we don't want to trade against our clients, but we want to have a business model which puts the trader in the middle of all our interests, and where we say we want to have a win-win-win situation. So what we want to have is, we want the clients to be profitable, we want our partners to be profitable, to make money, however, and we want to make money out of commissions here. We want to be every part and every business partner to make money and to profit from a pure, in this case, client-centric, trader-centric business model. And now let's close the cycle. Let's come back to the MT4 Plus. So what they did also here was, they said, well, we are traders ourselves. So Lars Gottwig, for example, is a trader. And he asked, well, what do I look for? What needs do I have as a trader when I'm looking for a broker? I'm not just looking for a broker who does not trade against me, but I also look for something where we can say, hey, I need tools I can work with, and which are making me faster, more efficient in the way I'm trading. I can trade the markets. And so they came to the conclusion, let's work out something like the MT4 Plus. Let's put in some extensive work here to work out tools like this mini terminal here. So usually you have a lot of trouble to place an order here, since you have to click in, then you have to say, okay, new order, and then you have here pending order like this, and you have a buy limit, a sell limit, buy stop, sell stop, that's it. And then you can place this order here. And what we need on the other way as a trader is, we need, for example, more order models. Or we need to say, okay, I want to, without having a calculator in front of me, say a percent of equity, percent of balance here, for example. I want the add-on, in this case, this mini terminal add-on, do this all in an automated process, so that I can focus on my trading, while this tool here makes all the work in terms of calculating. And so they started to develop several so-called add-ons here, like for example, it's not just the mini terminal, but it's also like the correlation trader. It's like stealth orders. It's like the trade terminal, a big one. So like, oh, I'm sorry. So let's do it this way. Trade terminal like this. So you can do this. And now, one sec. Look at this, for example. Okay, so it's trader centric. It's trader focused. What you see here, and so this is exactly the thing which makes this tool so special, or these add-ons so special. The tool, the MT4 Plus, so special. And if you now click on MT4 Plus here via trading, then you can go to desktop and add-ons. And if you have, as I already said, a demo or a live account with JFD, you can download those here, the MT4 add-ons package, just by clicking here. You can just use it if, as already said, you're a JFD demo or a live client. Okay, so if you're trading with another broker, you can't use this tool. That's the deal, let's say. Okay, so now you have the MT4 trade terminal, as already showed, or the mini terminal depth of market, or the chart trader, or you have here the mini terminal, as already shown, or you have the Excel RTD. So build your own easy way to use and analyze trading dashboard, displaying important information such as account equity and balance, instrument prices, and a constant list of open positions, and so on. So stealth orders, you can have the tick chart trader. Stealth orders, what are stealth orders? Let's come back to them. Apart from placing pending orders, you can now also set entry and exit levels for your position that will also remain hidden from the market. Once the respective price levels are reached, the add-on will place your buy-sell orders. It can also automatically close multiple positions, even all orders in your trading account, if their combined profit reaches a certain threshold, okay, defined by you, for example. So all those little things, those add-ons, they can be found here in this where is it, here in this add-ons package. So these add-ons, I use them. I have to admit here, by the way, so I'm not using all of those add-ons in my trading. I especially use here the mini terminal, especially. But from time to time, I'm also using this sentiment trader, for example, respectively the correlation matrix. It's not the sentiment trader, the correlation matrix. But I think it's a huge is it fundus? I think it's a huge package here, which nearly every trader can profit from, I'd say. I'm not sure if I get this question. So does the system work in other patterns indicating slowing price, like triangles, just as a GBP NZD? You mean this open range breakout system? If it works also in GBP NZD, since you could also use it in FX pairs. It's not necessarily said that it's GBP NZD, but you could also use it in FX pairs. The only problem here is you have to adapt similar to what we did already here for the Dow Jones. So you have to define a trading area or a trading interval, which is an interval where you have kind of volatility and momentum, or chances are high that you get to see such a volatile market environment. You have to use currency pairs which showing a certain amount, a certain level of volatility. So I wouldn't use this open range breakout setup here. Again, so the plan is to anticipate breaks of several, of certain levels in the market, and then by anticipating such breaks to try to see a trend developing. If this is not possible, work with a clear take profit here. But you have to somehow use a discretionary approach here. I wouldn't use this, for example, in all Swiss franc pairs, like especially Euro Swiss franc or something. So, but you have to adapt it. That's what I want to say. So, like, if you're planning to trade Euro USD, so the main trading hours here in Euro USD are, for example, the trading hours around the London session, and that's between, let's say, 6, probably 5 p.m. a.m. GMT, and then up to, yeah, something like 3, 4 p.m. GMT. And then the idea here is the following. Let's do it that way. I think I've already prepared it. 1 second. So Euro USD. Yeah, why not using this here? So 50-minute time frame. So what do I have here? This is the so-called Asia range. You could say I use the Asia range here, and and in this case I use it from it's from 2 a.m. or I'm sorry, it's 12 a.m. GMT, and then up to 6 a.m. GMT. This is those pink lines here, and then you say I trade the break out of this range, like here. So let's see. Also here, important to have a clear advantage, for example. So first of all, let's see where's the advantage. If I see such a trade environment here, or market environment here, let's put it here. I'd say, okay, so you have a sequence of falling highs, falling lows. That was in March. And then you say, okay, I only trade the breakout of this range here on the downside. If you have such an environment, higher highs and higher lows, that's the rough version, then you trade it just in direction of the trend. So currently, I'd say, well, we have a sequence of falling highs, falling lows, so post the election in France, meaning that here I'd only trade breaks into direction of the trend, which is currently on the downside. Meaning today, for example, I'd be short Euro USD here. I'm short Euro USD based on the overall advantage from here and putting a stop here at those highs. So now the thing is, what do you expect in terms of moves here? Something which you could do is do the exact same thing as with here, as with the with this average daily range indicator. Well, you have the previous day range, which is 70 pips. You have the 5 days trading range, which is 70 pips. You have the 10-day trading range, which is 59, and 20 days is 65. So I'd say 65 pips chance on the downside should be expected and is likely. So what you could do is you could say, okay, I'm short here from 108.82. Put a stop here at 898. So you have a risk which is really attractive, I'd say, from 16 pips, and then say, okay, now let's see whether the market can move here 65 pips in my direction. Placing a take profit somewhere, I don't know, let's say somewhere in the region around 108.25. So the trade is still in play. Not sure if this is not a little too aggressive here, but it's definitely fair based on the average daily range. So there could be a trading approach here on the currency markets based on the open range, respectively Asia range breakout. So you could say, okay, I identified the Asia range, which is in this case, as already stated, 12 a.m. GMT till 6 a.m. GMT. Then say, okay, trade the break in direction of the identified advantage, which in this case is the short side. It's the sequence of falling highs and falling lows based on the price action from Monday onwards here. It's an intraday trading approach. And then, well, then you go for it. You could also do this here on a 5-minute time frame. Not changing anything at all, since it covers the day range of the day before. So it doesn't necessarily mean that something is changing here. Yeah, and so this is already an approach which is I think it's tradable. So I have to run a back test whether it works or not. But so far, I'd say it's definitely a fair way to use this approach here in the currency markets. Not sure if I would use it in GBP NZD, by the way. So I'm more someone who plans to trade such setups in very liquid pairs, which means Euro USD, dollar Japanese yen. You could easily adapt this, by the way. So you could easily say now Euro USD short side. Well, I know, for example, dollar yen here, you have this on the long side, the current market environment. You have the hourly chart here. You could easily see, okay, obviously higher highs, high lows, very strong trend yesterday, by the way. So really strong trend developing here. So yesterday, you've definitely made some money, but also here. So the market is really strong right now in the dollar yen after the Macron gap. So here after this breakout, you could easily trade in direction of the Asia break of the Asia range breakout in direction of the trend, and then you go to the 50-minute time frame, and then you say, okay, let's, I don't know, start from where? Probably you have the advantage already here. Is this fair? Can we do this? Yeah, why not? I mean, here you see, okay, the market is probably on the long side. Now you have a position. The question is, what do you do with a position at the end of a trading day? That's another question regarding your approach and how to exit a trade. You could say, okay, I closed the trade at, in this case here, 10 p.m. GMT. 10 p.m. GMT, or no, 8 p.m. GMT, or 21. Let's say 9 p.m. GMT, you could just close out the trade, and you don't want to roll over in the next trading day. Well, where you roll over, since you have a strong opinion on the trend, but let's say you just take out the position. So it's a small win here, just very small win, nearly break even. Let's see here. In this case, it's a small loss, so plus minus 0. Then this day, you hit it really hard, since you say, okay, I have a risk here when I put in on the trade of 20 pips. You have an average daily range here somewhere around 70 pips, and then you place this the take profit here at 112.86. Yeah, you nearly may get up to there. So you take out the position somewhere here, but you have a quite huge win compared to your initial risk, which is something like 2.5, 3 to 1. So here, what happens? Nothing happens. The breakout happens on the downside before it breaks on the upside, so no trade at all. This could be a easy rule for this. By the way, if I traded setup, this is definitely something I'd include here. If the breakout happens on the downside before it happens on the upside, where I identified the advantage, I'm definitely not taking the trade anymore. Could lead me to say right now, well, I'm not taking this Dow Jones trade anymore. While you have to somehow say, okay, look what happened here. So the market just spiked a little lower. Is it really a game changer or something? Discretionary approach, I'd say. So depends. I could imagine taking the trade right now. On the other hand, if you have a clear rule saying if it breaks the downside before it takes out the long side, while I formulate a long setup, well, I don't take the trade anymore. Well, you don't take the trade anymore. Next thing, the next day. Where is it? Here. Not sure what you're doing here. If you trade, or if you trade long, or if you don't trade it long, probably you take it, you don't take it. I don't know. Probably plus minus 0. You're still ahead here this week. Next thing here. Do you take it? You don't take it? Probably you don't take it, since the market breaks out on the downside first. Next time you hit it really hard, since the market is, well, where does it break out? Yeah, 114.10. So hitting the take profit somewhere here, 70 pips ahead of that, based on the previous day range. And the initial risk was something like 20, 25, 27 pips. And so you see that if you have a clear rule of, and those rules are not they're not difficult. This is not difficult rules. You just say, okay, I say this is the setup. I trade it long, I trade it short. Once the advantage is on the side of the open range here. No, I have the advantage. I trade in direction of the advantage. And then you say, I put my take profit, let's say here, in direction of the advantage based on the average daily range. If I have a really strong opinion here, I probably take out the take profit level to see a strong trend developing, like, I don't know, in the morning, the Bank of Japan in this case. It's not Euro USD, by the way, anymore. Okay, so it's dollar yen in this case. So here you can see it, or you can see it here too. Since they announced something which is killing the Japanese yen on a wide front here, but all in all, it's very simple rules, and I didn't make the rules now the way to make sure that I have a positive outcome at the end, but the rules are fair. Like I said here, do you really trade in direction of the trend? Where you plan to trade the open range breakout once it broke out before, and somewhere here in the afternoon when the trading day is nearly over. I don't think that I take this trade, even though I could have made a small profit here. I could booked a small profit when I've traded long here, and so you can see that you can easily adapt this to other markets here. This open range breakout scenario in case of the Asia range, adapt it to the Asia range. But as already said, if I traded, then I traded here from the only in liquid pairs. So that means Euro USD, dollar yen, probably GBP USD, probably Aussie USD, but probably not GBP NZD, even though I have to admit that those cross pairs tend to trend really strongly. When they trend, okay? So have a look here at GBP NZD. I cover it from time to time, since I have one in my morning meeting, one guy who's trading it very actively, GBP NZD. Look at this. I mean, and this is a daily chart. So sometimes it's really, really tough. But if it starts to trend, well, we are talking about 400 pip moves here in no time. Here in this case, 25th of April, the market moves up 600 pips in no time. This is 4 trading days. So GBP NZD, also GBP Aussie, they're strong intraday trenders if they trend. This doesn't happen very often, but if it happens, you could have a really nice payoff here. Oh, okay. So regarding the email address, not sure what happens if I type in Jens here. Yeah, that's good. So here's the email address you can send a mail to regarding the daily range indicator. Can you see this? Yes. So yeah, this is my email address. I hope you can see it. If not, well, then I'll put in the slide in during the last 5 minutes here. But usually you should see it here. You can just write me a mail and I'll send it over to you. No problem. Yeah. So any other questions? Probably let's have a look. I mean, we have 5 p.m. already here. My German watch. Here in Varna, it's already 6 p.m. So what I want to say is the trading day is coming to an end in Germany. So as I already said at the beginning, 5:30 p.m. German time, the trading day is over. Xetra closes. So the market, the spot market, and respectively the liquidity in general, thins out massively. So making it possible to right now already formulate some ideas for the upcoming trading day tomorrow. Meaning, well, where do we trade right now? Well, we are still trading in a region where I say I think it's highly attractive to consider going short here. The only problem I have right now is, and that's something I want to say here, and that's one of the reasons why I right now don't like to trade this open range setup in the equity markets. It's not, I'm not saying I present to you an idea I'm not trading. I'm trading it actively, really actively. But the only problem is that right now I just know that the market conditions do not fit this style really well. Sometimes you get lucky, but more often you get unlucky. And what I try to do right now is I try to somehow calm down my trading, let's call it. So and filter very aggressively and try to probably switch to higher time frames here. So I really like to go short. I'd really like to go short here in this region around 12,780 points. The problem is today didn't really work out. I was here on my trip to Varna, and so I hadn't the chance to really look the chart. But if I look at the chart right now, I can definitely say I wouldn't have done anything here in this current market environment. But what I can say is that if I plan to go short, somehow I'd like to adapt this whole setup a little and put my stop here above 12,835 points, the highs from last Friday, since I do not expect the DAX to reach this level. Meaning, if I now take a risk here of, let's say, 100 points, probably 80 points, I have to reduce the position size a little. But all in all, I have to say, somehow I have the feeling that the DAX is now topping out a little. And probably this is a good and solid fundament based on which we can now try to formulate a setup here tomorrow then in the DAX long or short. And where probably we'll try it with the DAX open range breakout here. So based on the same ideas, by the way, as already presented. So you might now say, well, do you really think the advantage on the short side? Well, therefore, I'm not looking at the hourly chart, but I also look here at the daily chart. And now look at this. I mean, this is exactly the thing I was talking about, where probably aggressive anti-cyclical short setups could be really interesting. So what I want to say is, the market is clearly bullish on the daily chart, but hugely extended here on the upside, meaning that rather sooner than later, there should be some kind of bigger move down compared to what happened during the last days. And that's one of the reasons why I consider short engagements to be really attractive. We are still bullish above 11,900 points. So this is something I have to take into account. I do not see the trend breaking here in the near term, but I definitely take I definitely take a shot here and try to short the DAX, but need to wait for a clear setup. Not taking any shots here right now, but wait probably for tomorrow for in the morning. But if the market presents itself in an attractive spot, I definitely go for a small short here, and yeah. In this case, then bet on a break below 12,700 points and hope for an attack, probably also a break here below the lows from Monday around 12,650 points. So could get interesting. It was already interesting today. Market didn't behave the way it probably should have behaved, but it's still in play. The bears are still around the corner somehow, and I have the feeling that there could be some attack on the downside into the weekly close here. Yeah, and so that's it from my end. Just look whether there were any more questions. No more questions. Yeah, then I just hope that you enjoyed the webinar. So I had some trouble here at the beginning, as already said, thanks to the power, but we fixed this little issue, and I hope you can take something with you for your trading. If you have any questions, just shoot me a mail, also regarding the indicators, and I just hope that you enjoyed it, and tune in next week again. That will be the 3 columns of profitable trading I'll present to you. Which could be a really, really interesting topic. Oh, wait, no, it's behavioral economics, it's behavioral finance. So it's the 3 columns of profitable trading, which I'll cover tomorrow, and next week on Thursday it will be behavioral finance. So that's one of my definitely favorite topics, since it has to do a lot with how people are, how they behave, especially when facing trouble, when facing pressure. And right now I'm reading a book here in German. It's called the Path to Fear. It sounds like a thriller, but it's not. It's a book on psychology, and it's a really, really it's a really interesting, really, really great book, and you can build great bridges here from fear to behavioral finance and back and forth, and play a little around with this topic, since it's a huge topic in trading in general. So I definitely look forward to this webinar next week on Thursday. And yeah, so that's it from my end. Have a nice day, have a nice evening, and talk to you next week. Happy trading, watch your stops, and see you then. Bye-bye.